a code. So if you go all the way out there and don't have the code, you can't get in. It's a little awkward to come back. But the code is, we normally write on the board, it's 5757. So like, remember Heinz 57. That's a good way to remember it. So Mark will write it on the board.
There you go.
So it's 5757 to get in that bathroom down there. So if you need to go to the bathroom, there's plenty of coffee and juice and water and snacks. We got Panera bread. So please help yourself during the event. Please get up. Hey, welcome. Are you Danae? Yeah. Good to see you, Danae. I'm glad you. Did I say it right? Diane. The fancier way. The fancier way to say it. We're glad you're here. Glad you're here. And if you're watching live on YouTube, Facebook, not LinkedIn because it's not working. Where else are we? Live on Zoom. We're glad that you're here. I just did get a text from somebody that said that they were having trouble getting in the Zoom, but I'm going to trust that it all got solved and we're ready to go. So, producer Garen, are we ready to sit down and get this show on the road? Give me a word. Justin is my apprentice. He's managing all of the equipment today, so he's doing great. We're ready? All right, so we need to get the phone camera back in position, and then we'll get started. So this is going to be very interactive. So if you're online and you want to ask questions about anything that's going on in the event today, you will be able to ask those questions no matter where you are, whether it's on Facebook, whether you're on YouTube, or you're on Zoom. You just go to the Q&A panel or the chat panel, and you can ask questions. My apprentice, Justin, is going to be managing and monitoring all that to ask questions from you watching on the live stream. And then also, if you're here in the room, all you got to do is raise your physical hand in real life, and we will answer your question right here. So anyway, let me explain a little bit about what we're doing with the EMS Live. So I have been doing EMS webinars. EMS stands for Entrepreneur Master Series. I've been doing these webinars now for, I guess, a couple of years, a year and a half, maybe 2 years, and been doing these about every 2 weeks to once a month on average. I'm moving them more towards once a month so that we can focus on higher quality rather than higher quantity. And I decided with my team about, I guess, 6-8 months ago that we should do some of these live and in person, also live stream like what we're doing right now to you watching on YouTube or wherever you're at. And so this is the second live one that we've done. We did one a few months ago on podcasting for profit. Today we're doing one now on whole life insurance and financial planning with the hook about Dave Ramsey being wrong. Everybody like, that's the hook. I got a lot of hate for that hook, but it worked. You're here, so it worked. And we're not going to really bash on Dave a lot. We are going to talk a little bit about it, but I will tell you this, and I'll do that. I'll save more of this story for later, but I just had a conversation with one of Dave's longtime employees. He doesn't work for him anymore, about this concept just within the last couple of weeks. And I pushed back a little bit on this, and he had something very interesting to say that surprised me, and I'll save it. So it's a little teaser. We'll save it for what he told me, huh? Yeah. So anyway, this one is going to be on life insurance and certified. He's a certified financial planner, which I'll introduce Mark in just a minute. But that's what this one, and I got another one coming up in a month. Now, I don't normally do these as close to the back-to-back like this, but the next one is on AI, and I've got actually even more information about that I'll share at the very end. So don't log off. Don't leave the room. I want to tell everybody about what we're doing with the AI next month. I got a guy coming in who's an AI expert from Vegas, and we're going to be spending a couple of hours in the morning talking about AI, specifically about using it for lead generation. Everybody want more leads? You want more leads for your business? That's what we're going to be talking about, but I'll give all the more information about that at the very end of our session today. So are we ready to go? Is everybody in here ready to go? We good? So all right, so let me go ahead and introduce Mark Willis to you. He's our guest expert for today. Flew in from Chicago this morning and is flying back home tonight because he's a committed family man. He didn't want to be away from wife and kids. How many kids you got? 2?
Just one.
Just one?
And a puppy.
And a puppy. A daughter and a puppy, right?
That's right.
7-year-old daughter?
Yeah, you got it. Yeah,
I remember. It's all coming back to me. It's fuzzy. So let me tell you how I found out about Mark. So Mark and I were introduced through my podcast. I've got a podcast called The Root of All Success, and I interview very successful entrepreneurs about their journey to success. We talk about success and all the details around success, and interviewed a guy named Josh Wilson. You know Josh, right? Obviously. And so Josh and I were talking, and Josh is a great connector of people. And he said, hey, there's a guy you need to know. And his name is Mark Willis. He lives in Chicago. He's a certified financial planner. and he works mainly in the whole life insurance planning as part of your certified financial plan. And this is a methodology that I've been implementing for the last, I guess, 4 or 5 years. And I'd love to talk to this guy. So Mark and I started talking, and I had a guy that did my insurance, but I didn't have a guy who did my financial planning based on insurance. So I ended up hiring Mark to be my certified financial planner and put my policies with his agency. And now we've teamed up, and I recommend lots and lots of people to him. He is one of the world's foremost experts on bank on yourself. Now, there are different concepts around the idea of using whole life insurance and about building this I mean, we got another insurance guy in the room today. Mark, good to see you. There's all different kinds of ideas around it. There's a LEAP method, there's the infinite banking concept, there's bank on yourself, and there's probably others. But Mark is certified in bank on yourself. And I know he'll talk a little bit more about that. But the guy's got a heart of gold. He knows his stuff better than anybody in this space that I've ever talked to. And I think today you're going to really, really, really enjoy hearing what he has to say. And we're going to be able to answer your questions. And possibly at the end, and we didn't talk about this, we might even just do some whiteboarding of some scenarios. And we've even talked about, we need to do that. We've got the mobile camera that Justin will operate. We'll get over here on the whiteboard.
Cool.
We bought brand new markers just in case.
Cool.
So we're ready to do that. But just by show of hands, physically in the room, does anybody currently have whole life insurance as part of your plan? Okay, a few people. Online, if you're watching online, go ahead and hit the thumbs up or indicate that you have it online. Justin to be monitoring that, looking for questions. And again, if you've got questions that you want to ask and you're online, just ask those anytime. And Justin will raise his hand and let us know that there's a question from online, and we'll make sure to take those questions online. So, all right, I think we're set. Mark, welcome to EMS Live. Glad you're here, man. Glad you're here. So you've been doing this for quite some time. I'll hand you the clicker now.
Oh yeah, sure.
So you've got the clicker. So cool. You've been doing this for quite some time. Tell everybody first of all how you got started in this idea of bank on yourself.
Sure. Yeah. Well, at the present moment, I've had the great privilege of working with folks all across the country in all 50 states. But a lot of them are in real estate investing, or they're business owners, even some NFL Super Bowl champions. I don't know if you knew that or not, but no. Most of the people I work with are just trying to have more control over their finances and want to have a sense that they're working toward a goal that's actually going to be accomplished. And nothing worse than fighting toward a goal that ends up getting taken away from you because of something outside your control. But it started with me in the midst of like massive amount of debt, like up to my eyeballs style debt. And mostly student loans was, the snakes in my portfolio. And we graduated in 2008, right when everyone was hiring. You probably remember what a great job market that was. And, just not having a lot of work to do, we were faced with, dirty jobs. That was me. I was the guy under the elevator with the shop vac, pulling out whatever you could find in the muckiest, nastiest jobs you could get, anything to pay that giant nut Sally Mae every single month. In fact, I jokingly say I married 2 women in college, my beautiful wife and also Sally Mae. And I wanted to get her out of our life as fast as possible. But we were throwing hundreds and even thousands of extra dollars toward our alimony with Sally Mae to get her out of our life as fast as possible, because we listened to Dave Ramsey. He was our North Star. I had not just drank his Kool-Aid, I was swimming in his Kool-Aid. And we had a lot of good things from that. A budget figured out. So I can always appreciate Dave for his getting us focused on money, because my biggest problem out of college, because I didn't get a finance degree, I got actually a theology degree. I don't know if you knew this or not.
I didn't know that.
Yeah, I got a master's.
We both have theology degrees.
Is that right?
Yeah,
oh, cool.
Yeah.
Right on. I jokingly say,
God approves this message.
God approves, yeah. I always jokingly say my favorite book of the Bible now is the book of Numbers. So there's your dad joke for the day. So anyway, we were totally not marketable skills in a worldwide recession. And we were really not easily able to talk about money because we're just young kids getting married and big time in debt. And so we got our budget straightened out because of Mr. Dave. And so I'll always give kudos to Dave Ramsey for that. But then a theology professor of mine came to visit us, and he told me about this thing called bank on yourself. I think he was sort of feeling a little bit, guilty for helping us get into all that debt in the first place. So he shared a way out, and my mind went dark. Like as soon as he said the word whole life insurance, my mind closed. I was totally thinking this professor of mine was in some sort of scam or something that I needed to help him get out of. So I spent the next 7 months of my life really trying to prove this thing wrong. And in the midst of that, I also was working for a CPA firm and had a, kind of an awakening that the stock market was not all it was cracked up to be. There were people, I was listening to the phone calls of this, nationally recognized CPA. She was very good at what she did, but she had to make those calls. And if you're in finance, you might know these calls. It's when you call the client and say, I'm sorry, Mr. 62-year-old client, I know that we were on track to retire this year, but the market just took your retirement away from you and you can't retire like we thought. We just lost you half your life savings or a third of your life savings. I mean, the S&P 500 was off 40% this year, Mr. Client, so we can't retire anymore. That's the moment I almost got out of the business completely, because why do that to a person? Why crush their dreams, ruin their life, and take a fee for it? So that for me was almost the walk away moment. And then my professor walks in and tells me about this thing called bank on yourself. And so slowly but surely, I began to realize this might not only be a way for me to get out of debt, but it might also be a pathway for my own financial, retirement and plan, and also those of people I might be able to serve someday too. So we ended up starting a practice, Lake Growth Financial Services, which again works in all 50 states. I got a certified financial planner designation and kept trying to prove this thing wrong and tried to do my best to, see that Dave Ramsey's advice was not a scam, like he calls this, what we're going to talk about today. He calls it a scam. He calls it, a pile of manure. I mean, he gives you the best reasons logically to not do what we're about to talk about, right? I mean, those are all logical reasons. So, we're going to get into more of what this means today for folks that are familiar with Dave Ramsey's arguments, but we also are going to let you in on a little secret that maybe Dave Ramsey does not have a corner on truth.
Yeah. So how many of you here are like either now or historically have been fans of Dave Ramsey? Listen to the Money Game back in the day. Yeah, I remember back in the mid '90s when he started the Money Game with Roy Matlock. You got if you've been in Nashville a long time, listen. Like I listened to him from the day one, and I drank and swam in the Kool-Aid. And my wife who's here today, we sat down and did budgeting and did the $1,000 emergency fund. We did all that. So for years, it was that was what we did. So we have a very similar background. And I remember calling him on the radio show one time. I did get through and we did have a conversation, but this was back in 96, probably 1996. And of course, life changes significantly. Back then I was a minister making like 14 grand a year. So life was like, that's who I think Dave's advice is for. Not $14,000 a year, but like you get the point. It's for employees mainly. It's for corporate people that trying just to do it the old-fashioned way, but it works for them,
right?
So I asked this guy, and I'll tell you what this guy said. So this guy worked for Dave Ramsey for 16 years, and he's actually coming on my podcast. And when he told me that he worked for Dave Ramsey, before I knew his stance on anything, I started talking about, oh yeah, and he goes, oh, so you graduated away from Dave Ramsey? Oh yeah, I think I did. But I don't think he thought that was a good thing. I don't know what he really thinks, but he did say, because I pushed back, I said, there is no way Dave Ramsey doesn't have debt. There's no way that he's not using life insurance. There's no way that he's not doing it. And the guy said, yes, there's a way. Like, dude is 100% locked in, according to the guy that's worked with him for 16 years. So I give credit to Dave for that, because I just knew there ain't no way. But here's what I thought about this on the way in today, Mark, and I want to see what you think about this. Dave is not a billionaire. He's very wealthy. I think his company brings in about $300 million a year. Okay. That's a lot. That's a lot of cash when he just started on the radio talking to people about this and develop financial peace and all that. he would be a billionaire if he did this. What do you think?
I'd say you're probably right.
I think if he leveraged his money, he'd be a billionaire. Now, he might not want to be a billionaire. Maybe that's not his goal. But I believe that if he used these things, he'd be a billionaire. But he's not. So he has for those of you that are in Nashville, or everybody live here in the Nashville area, but there's that big building, Ramsey building downtown, Ramsey Solutions, south of Franklin. He built that cash. That's the whole thing. What's that building worth? Probably $50 million. I have no idea. I'm guessing paid cash. But if he leveraged that, he could turn that 50 into 100 in a year. That couldn't he? I mean, it just. So anyway, we're all going to have the opportunity to become billionaires. That's the whole point of today. That's where we're at. So why don't we go ahead and hop into this? But I'm going to do this. Renee, I've got some people that are texting me, and I want to make sure nobody's missing something. So if I hand you my phone, will you just? There's a text coming in right now. So if you would just make sure, and if it locks out, my wife can unlock the phone. So I think your fingerprint works, so you know my code. You know my code. All right. So again, if you're watching on the live stream on YouTube or Facebook or Zoom, please make sure you put your questions in. You don't have to wait till a certain time. Just put those in there. And Justin, if they come in, just raise your hand. Just get my attention. I'll know, and then we'll go towards.
Should I stay in this area here? Stay seated, walk around?
I think we need to stay for the camera's sake. I think we need to kind of stay here.
You bet. All right.
So
I've had enough coffee. I could probably be hanging off the ceiling over there. Just kidding.
All right. So you've got the clicker. Let's dive in and feel free to take notes. And we can share these slides with you later. Of course, this is all being recorded. It'll be on my YouTube channel. It would have been on LinkedIn, but LinkedIn shut me down. So it'll be.
They probably knew this was coming.
Dave.
Yeah.
Dave, what are you doing, man?
Yeah, he's got his in. I'm telling you.
I tell you, I've been on LinkedIn for what, 2 decades? I don't know, a long time, and never had any problems. And the day of this event, I get shut down.
Something's up with that.
I don't know.
Yeah.
I don't know.
Well, okay. So we're going to get into why Dave Ramsey is wrong about bank on yourself. And again, just a bit about me before we dive in. And I need to also just check with you. When should
special for them, but everybody who's watching this live and or online, or if you're watching this later, there is a link that he's got here in the slides. It's bit.ly/mycall that you can book it was a 15-minute strategy session with Mark about bank on yourself and how to do this. So you can go there. And then the bigger picture, even after this is all over, I have a landing page on my website called Bank on Yourself. So if you just go to therealjasonduncan.com, slide all the way to the footer, just click Bank on Yourself in the footer, and it takes you to a page where you can fill out information requests, and Mark's team will reach out to you and help you with that. So,
and I can officially say now that I've met you in person, you are real. You are real.
100%.
The Real Jason Duncan.
100%.
So go to therealjasonduncan.com/bank on yourself, and we can have that conversation as well. So let's get into, this is what I call the attorney slide. This is where all the disclosures will be. I'll also splice them into the slides as we go, but take a picture of this if you love reading footnotes.
How are you? Better than I deserve. How can I help?
Well, I had a question for you. I've been working with a financial advisor who's giving me some advice, and I follow the show. I'm on basic stuff 7 currently. But he presented me with an idea that was a little outside the box. And I have term life insurance. I have yeah, I have that discount.
Let's pause that. We got some problem with the audio. Hang on just a second. All right. Garen, hey, do you know what's going on with that? So we got to ask our producer.
We want to turn our mics off?
Our mics are off. Nope, our mics are back on. Why is it not going down? All right, well, let's turn them off.
Folks online, but anybody.
I'll turn this down.
All right. Are we
It's our
good?
second time, folks. Come on. It's our second time.
We good? Good.
We're learning.
How did you feel listening to Dave Ramsey? Put it in the chat if you're online, and Justin, feel free to chime in. Anybody in the room, how did you feel? What did Dave make you feel when you heard him talking about this? Terrible idea. You should believe Dave. Yep. Anybody else have any feelings? Happy, sad, disgusted, excited? Nervous? Yeah.
He was moving around.
Yeah.
His body language was all over the place.
Yeah. But what? He's selling you a dividend? He's not really a financial advisor. He's an insurance guy. Yeah, me neither. Anybody else have any gut reactions in the chat or here in the room? It's important how you felt because honestly, Dave sells the emotion. That's what he's done so well for decades. He is so good at teaching fear and disgust. And actually the human feelings of fear and disgust are actually really the core. It's in the amygdala part of your brain. I mean, that's like the fight or flight, don't touch that poisonous mushroom kind of feeling. And if he can get you to feel disgusted toward whole life insurance, you're going to notice that that's how you feel. No matter what anybody presents to you, your feelings, your emotions are really going to be what drives your decision.
Yep.
So, that's sort of the approach that he takes. And this is the face that I kind of really caught on to here. This little face, I think, is the disgust face, right? So is it really, he calls it a terrible idea later in the video. And it's a 9-minute video if you want to watch the whole thing. You can find it, just search YouTube for, infinite banking scam, Dave Ramsey, you'll find this video. But is it really such a terrible idea? Let's get into it. But before I get into Bank on Yourself, let's first figure out, Dave's been doing this for decades. He's been in this business for decades, and good on you to him for running a great business. And who's going to fault him for that? But how's his advice been doing for us as the average American? This is a picture of the average American's financial plan. I would call this a financially unstable financial plan. So if you took a pyramid, pyramids are very strong at the foundation and very tiny at the top. Most financial plans are upside down like this, where we've got a very tiny portion of our wealth in liquid, guaranteed, like bank accounts, savings accounts, money in the vault, safe, predictable, liquid cash is a very small slice of our overall portfolio. The vast majority of our wealth is in our homes and our 401ks. Okay, in fact, a recent study says that 47% of America could not come up with $400 for an emergency. That's half of everyone walking down the sidewalk that you cross on the street, or every other car you drive by in the car on the street today. Half of America can't come up with $400. That's a big problem. That doesn't mean they don't have 400 of wealth. It just means it's locked up, can't get access to it. I'd also say there's 31% of America have no retirement savings at all. And what is it? 27% of us, 1 in 4 of us, are over 60 and have no retirement savings at all. So this is how we've done listening to Dave's advice. If he's the #1 financial infotainer in the country, here's the results of our efforts, or of his efforts. We are still a nation of debt. We spend more time planning our vacations than we do planning our retirement. I just read this morning that we've now crossed $2 trillion of credit card debt. That's the highest it's ever been. 28% of America have more credit card debt than they have savings, and more debt today than at the height of the Great Recession. And we have actually, this is a crazy statistic, 36%, 35.9% of our income goes to servicing our debts. So let's just think about that for a minute. 36% of our income goes to service our debts. So if time is money, what's 36% of your day? Okay, that's waking and sleeping hours. How many of your waking hours are spent servicing debt? Or put it another way, how many waking hours of your life are you a slave to a bank? Because that's what it is. The Bible says it, right? The borrower is slave to the lender. Dave Ramsey loves quoting that verse. But if 1/3 of our day is being a slave to a bank, well, wow. Then we add taxes on top of that, and half your day is gone working for somebody else, even if you think you're a business owner. So what's the problem? What's the underlying problem of the American experience with money? Is it debt? I don't even think it's debt. Is it no savings? I don't even think it's no savings. I think the biggest fundamental problem that I see as a certified financial planner is that we're not thinking long range. We're not thinking long range. All right, so let's talk about airplanes. I just got off one this morning, and we got here early. How did we get here early? The airplane didn't have extra nitrous oxide in the gas tank. At least I hope it didn't. So how did we get here early? We got here 20 minutes early today. How did we do that? Well, let's imagine you have an airplane. Let's say your airplane can fly. It's one of those little prop planes, so it can do 100 miles an hour. Get that little engine going. You can go at 100 miles an hour. But we've got a headwind. Our airplane is getting pushed backwards at 200 miles an hour. Some of these high-level stratospheric winds can get really strong, apparently. I'm no pilot. But let's say that you're getting pushed in the face 200 miles an hour. Now, Jason, that's not real hard math. If the airplane is going 100 miles an hour this way, but the wind is coming 200 miles an hour right at you, are we making any progress?
No, you're probably moving backwards.
Moving backwards. Yeah. I'll be getting into Canada before lunchtime. So that's a problem. Most people are spinning their wheels, pushing as hard as they can into that wind. So most people think, well, let me just pay off my debt, get rid of all that headwind coming at me, and I'll wait till I'm just debt-free. And I'll call up Dave Ramsey and I'll scream, I'm debt-free! And then we'll be debt-free, right? And we'll have no wind coming at us, and we'll be able to get down to Nashville at 100 miles an hour. And that's as good as it gets. Most people think that's as good as it gets. To be debt-free, that's the ultimate life. I'm here to say, and I think you're here to say too, that there's something better than being debt-free. What's better than debt-free? What's better than no wind at all? Having a tailwind. If you can have some wind pushing your little airplane. Maybe there's a tailwind of 200 miles an hour, plus your little engine can cook at 100. Now we're really cooking with gas. That's how I got down to Nashville before the landing time, before I was supposed to. So the tailwind is what I'm after. The tailwind, I think, is what's going to be necessary for most of the business owners watching this today and here in this room today. The tailwind is what makes all the difference. So we got to think long range. Until then, we got to fuel up the gas tank. Land that plane. If you got a headwind coming at you like a monster, sometimes it's just better to land the plane, think long range, build up your savings, and then get ready to have that tailwind. Because winds always change, don't they?
Yeah.
Winds always change.
You know, Seth Klarman, who's a self-made billionaire. I don't know if you know who he is. He's an investor. He said that the number one thing that an investor today can have to get us towards generational wealth is a long-range view.
Mm-hmm.
That's what he said. He said it's not about real estate. It's not about insurance. Not about anything. He said the number one thing you think is have a long-range perspective. That will get you to generational wealth better than anything else. So I think you're right on track.
That's it. Yeah, I really think we've lost that as a nation. You know, there's mortgages that are 100-year mortgages in Japan. Can you even imagine that? There's
Can I sign up for one of those?
Yeah. The rates are probably great. Right?
$250 a month house payment, right?
Pass it on to the grandkids. You know?
That's right. Yeah.
So there's 500-year business plans in other countries. So can you even imagine? We have a hard time getting past quarterly earnings in this country. So that's fine. So the airplanes, when you can get a tailwind, really you're cooking with gas. All right, so as you were just saying, long-range planning. Rich people plan for 3 generations, but poor people plan for Saturday night. That's a good quote, right?
That?
Yeah, Gloria Steinem.
Oh, yeah. Well,
Don't agree with everything she says, but I really like this quote. So.
Yeah, that's a good quote.
So most people's financial plans are built for those quarterly earnings too. It's not just the business owners on Wall Street. It's all of our quarterly statements and our 401ks. Oh, we're up this year. We're feeling great. We're feeling wealthy. Ooh, we lost some last year in 2022. It was a down year in the markets. Ooh, we can't go to Disney World with the kids this year, you know? So up one year, down the next. I want to show this example here. This is something that I think really shocks most people. This is Jim and Jane. They both have a portfolio equaling $500,000 when we meet them. And they both are going to have the same rate of return. They're both going to be taking withdrawals in retirement at the exact same rate. So they're taking the same income out, buying the same groceries, living the same lifestyle. They're both 65. They both get the same average rate of return over these next 15 years or so. But one of them ends with 74 grand. The other one ends with $344,000. Now, how is that possible? They both took the same money out for groceries. They both had the same rate of return, and they both started with the same portfolio balance. How can they possibly end up with such different results? The answer is the order of the returns that they received in Wall Street. They're ordering the returns. All I did was I flipped the returns upside down between Jane and Jim. I flipped the returns upside down. It's the same average return. Same average return. The only difference is I flipped upside down, which is the one thing we really can't control, is the order of the stock market returns you have in your retirement. So Dave Ramsey loves to say, hey, you can just fall off a log and get 12% on your mutual funds. I don't know how can he claim that? You know, we'll get into the real research on that soon. But here's an example where you could get 12% and still end up with no money.
This is actually something, Mark, somebody told me 3 or 4 years ago. He was one of my advisors. He was saying, look, this is how a financial advisor, he was not a financial advisor, but he said, here's how a financial advisor can claim, hey, we get 25% average return for our clients. And he did the math, and I didn't believe it. He goes, but I can show you that they're not making any money. And then I said, okay, show me. Because if 25% is 25%, started at 100, I'm just doing math, like 125, and then 125 plus 25% is another, whatever that is. I can't do the math off the top of my head.
Yep.
But he goes, well, you can get 50% one year, 25% the next, negative this year, and you can show an average, but at the end of the day, they've actually lost money.
That's it. Yeah.
It's true math. And if you do it, it'll scare the crap out of you, because I don't know who your financial advisor is or who you're working with, but whatever they're claiming an average doesn't matter. This, what you just showed, it's the order of that return, not the average of the return. That is
That's right.
that's probably the biggest takeaway so far, is just check that with your financial advisor.
There's no such thing as averages. It's
Exactly.
just like Sesame Street said. There are no averages. You are unique, as Sesame Street says. So here's the rate of return change between the year 2000 and the year 2016. The average return of the S&P 500 was 5%. 5%. So after all that nonsense in 2001 and 2 and 2007 and 8 and 9, all the drama of 16 years here, and we averaged 5%. Now, first of all, is anyone here willing to do that again for 5%?
No.
I don't think I am. But what was the real return? If you put $100 into the S&P 500, had no fees on that money, okay, that's a big point, and there was somehow no taxes on that money too, your actual return would be 3.35% in the same years. Wait a minute, how is that possible? I thought the return was 5%. How did we end up with less money than what the index was advertising? It's just like when you go to McDonald's or Burger King, you see what's advertised on the menu, and then you get that floppy, sloppy looking piece of meat. It's not always what's advertised that you end up getting, right? So this is the reason why averages are meaningless. Have you guys ever, I just took a plane, you guys have probably done that too. The straight line, as we say, I think probably in Nashville too, you say as the crow flies, right? The straight line between 2 points is always going to be less bumpy and a lot more efficient than the bumpy, curvy, jerky turns and twists that you might have to take on the ground. Like if I'm going straight from my house to home, that takes me a lot less fuel than if my wife tells me I need to go get the dry cleaning, then pick up some books at the library, then go get the kid at soccer practice, and then go home. That's going to take a lot more fuel and energy and time than if I'm just going straight line, beelining it back to my house. That's true with the market too. All of the volatility that we experience just leaches our rate of return from us. And here's some of that man on the street arithmetic you were just talking about there. So the first one says, hey, we're up first year, we're down 10% the next year. If you go up 10% the first year and you go down 10% the next year, the man on the street just says, hey, I'm even. Went up 10, went down 10, I'm even. No, actually the returns are actually negative. If you put $100 into something, you're up 110. Drop 10% the next year, you're actually down at 99 bucks. So you lost money.
This is what I was talking about.
Yeah.
This is exactly. I didn't know he was going to say this. So
Yeah.
This is good. I stole your thunder. Sorry.
Yeah, that's okay. How about going up 100% this year? You get an investment, you go up 100%, then you drop 50% the next year. Well, that's okay. You still got an average rate of return of 25%. Pretty good, right? Pretty good. No, actually, you had zero gains. You went up from 100 to 200, cut that in half down to 50. You had zero gains, but that was an average rate of return. Jason, if I could give you an average rate of return of 25%, would you pay me a nice fee for that?
Yeah. Well, I think the interesting thing about that is that most people don't understand that averages don't add and subtract and multiply the same way whole numbers do. You know, a 25% plus 10% is not 35%.
Mm-hmm. That's right.
And if you've ever shopped and you had a coupon, they had a sale, it's 10% off, and you had another 10% off, you don't get 20% off. You get 10% off the first, if it's $100, it's down to 90, and then you get another 9 off. Now that's close to 20, but it ain't 20.
That's right.
So percentages don't add the same way whole numbers do. And that's why certified financial professionals and other financial professionals besides Mark can say, I'll get you 25% average return, and you're making zero.
Does this seem fair to you?
No.
SEC guidelines, the Securities Exchange Commission allows financial advisors, including me, to advertise 25% rate of return in this example. But do you feel any wealthier as a result of that?
You might feel it.
You might feel it. Yeah.
But you ain't.
Yeah, you ain't. That's right. How about this one? Last one here. 60% up in the first year, down 50%. That's still a 5% average. Oops, you lost money. Your $100 went up 160, and then you dropped 50% down to $80. You still had a positive rate of return, but you ended up losing money in the process. That's a big deal. You don't realize that every one of our 401ks, IRAs, stock brokerage accounts, they're all following this myth. And Dave Ramsey claims the myth on his radio show when he says you can get 12% averages. Now, even if 12% average was even possible, and I've never seen a brokerage statement that shows over a long period of time 12%. In fact, I had a running wager with a bunch of other folks. I had like, real estate guys, mortgage guys and gals, and attorneys. We'd meet every other week or so for breakfast. And I would actually, I'd make a claim. I'd say it was around Christmas time, and I would give everybody the chance. I would donate to their favorite charity. It started at $500 a month, and I upped it to $500 donation to charity, $750 charity gift, $1,000 charity gift, if they could just bring me a brokerage account that matched what Dave Ramsey claimed. And no one ever brought it. I was like, man, I'm trying to be generous to your favorite charity here. But no one could show me a brokerage account that had anything close to 12%. All right, with all that in mind, where are some options? If following Dave Ramsey's advice may have a few leaks in the well, where can we put our money to do what we want it to do? Where you put your money makes it do different things. It makes it act in different ways. So where your money lives matters. I've got a little goldfish, or not a goldfish, he's a betta fish in our home aquarium. And if my daughter is watching, tell Ice Cream hi and make sure that you feed him today, all right? So Ice Cream the fish is under our complete control, meaning he's really dependent on us. If we want to mess with Ice Cream's little life, we could probably pretty easily ruin that little fishy's life, or end it even, because we control the environment where our little fish lives. We know the food timing, we have the temperature of his water, we basically control everything about that little fishy's existence. And most people have their money in places that does not allow it to thrive. Just like if we put that fish in the wrong environment, he's going to end up floating at the top of the tank. But if we put our fish in the right environment, he's going to survive, thrive, maybe multiply with other little fishies and floating around in there. But most people's money lives in places that do not really benefit them. Wall Street, 401ks, IRAs, banks, credit cards, finance companies, real estate, inventory locked up, and of course a shoebox are all regular places people park their cash. Now I'd like to say this is what a healthy financial portfolio should look like. And this gets me into a lot of trouble with the average financial planners out there, but I'm not your average financial planner.
That's your podcast.
That's right. Yeah.
He's got a podcast. It's actually on some of the slides. NYA
Financial podcast.
NYA Financial Podcast, not your average financial podcast.
Yep.
So go listen to this podcast. It's really good.
The brand works. So yeah, we don't believe in averages, as I just showed you guys. So that's part of why I'm a big fan of not averaging our returns, because I don't believe in averages. I believe in being awesome, not average. So this is what an awesome financial portfolio might look like. High liquid portfolio, pools of cash for your business, for your family, and using that for leverage that helps you become not just debt-free, but better than debt-free. So if you guys could really paint a picture with your own money, if you could design, let's say that you were Pope of money for the day, you were Jerome Powell for the day, you were the Federal Reserve Chairman for the day, what would your money do for you? If you could just design a brand new, totally legal financial vehicle that could do everything you wanted it to do, your money would act exactly the way you'd want it to, what would be some of the characteristics or attributes you'd want your money to have? I'm going to stop my presentation, get your ideas, and I'd love to get anyone in the room to chime in or people on the chat. Best characteristics. I don't need nouns. I'm looking for like adjectives and verbs and things like that. What are some different functions you want your money to have?
Anybody?
Growing. All right, that's a good one. Great answer. Great.
Reproduce.
Have little baby fishies. Yeah.
Baby money's coming in.
Yeah,
multiply. Bring back friends.
That's right. Bring back friends. I like it. Take care of itself. Yeah. Kind of give it a chance to do something in a predictable way. You don't have to micromanage it all the time. That's a great answer. Great answers. There you go.
Yeah. Recruiting others.
Mm-hmm. Recruiting others. Yep.
Safe.
Mm-hmm. Yep. Good stuff. Just, I don't know if there's anybody in the chat talking, but let us know if you have any answers there. Anybody else have any ideas or other ideas?
I want it to be liquid.
Mm-hmm.
Liquid, so I can get
access to the money.
Get access to it.
It's a good one. Yep. That's a good question to start with. And if you take nothing else from this presentation, write that's a writer-downer right there. What would you want your money doing for you? What would you want your money doing for you? All right, so what characteristics, what attributes would you want your money to have? If you were in complete control of how your money acted, what would it be like? Here's a few yes or no primer questions. You can jot these down and think about it yourself. A little journal entry if you want. First of all, is your money safe? We heard that brought up.
Yeah.
What about guarantees? Is your money guaranteed to grow every single year, predictably, with a competitive rate of return? Are there going to be any penalties to get access to your money? I have a person who just lost his job. His only money is in a 401k. He's younger than 59 and a half, so the government thinks he's not an adult yet. So he's going to have to pay penalties just to get that money out. Liquidity. If you get that money, is it yours? Can you get access to it? What about leverage? Can you create the most amount of wealth for the least amount of cash? Skin in the game. Leverage is huge. We talked about that earlier.
Yep.
What about tax advantages? Do you want it to go in with tax advantages? Do you want it to be available without getting taxed every year? Do you want it to be tax-free anytime you get the money out? These are important questions. If you think taxes are going up in this country, very important questions if you think taxes are going up. What about tax-free available, not just in retirement, but even right now too? How about private? That's one not many people think about, but they immediately want it. They want that money off the radar of really everybody, but especially like government, colleges. If you want to send your kid to college, most people don't realize that every dollar you have in your savings account penalizes your child when they go to get access to financial aid for college. So getting money into a private arena where it's camouflaged when you need it to be is a really smart move for a lot of folks. Collateral, can we use this as collateral for other money or other assets? And then finally, can we transfer it without getting dinged or ripped off? Can we even pass this on to future generations? I'd like to say yes to a lot of these. So is there any financial vehicle that can do everything? Most financial advisors say, well, you need a broad portfolio of 13 different financial assets. You're going to need a team of attorneys to create a trust for you. You're going to need certainly our well-oiled machine and well-financed portfolio operations machine where you can pay us a juicy fee every year. Is it really true that we could do everything I just said without it being a super complex dynastic trust costing you tens or even hundreds of thousands of dollars a year? The answer is yes, you can. We'll talk about where to put it. A couple places you can stash cash to build liquid money. You got your mattress. You guys know about that. Put it in the mattress. Savings accounts, CDs, and money market accounts. There's positives and negatives to each of these. Obviously, there's plenty of liquidity under the mattress, especially if you got a water bed. But if you have it under the mattress,
That's
it's
an
not.
80s joke.
Thank
right
you.
there.
Yeah. Does anybody still have those?
No, I don't think so.
I obviously don't.
Yeah.
No interest. There's poor security. Obviously, someone could come in and steal your stuff from under the mattress. And a savings account is very liquid, but it's, again, earning very little interest. There's certainly certificates of deposit. They do offer higher interest rates these days with higher inflation happening. But still, it's not very liquid. Once it's tied up in that CD, it's hard to get access to that money without penalties. Oh, by the way, CDs will tax you every year. Not many people realize this. But when they advertise on the bank, signs that they're offering 4% CDs, really you got to think about that according to your tax rate. That might be closer to 2.5% or 3% rate of return on a CD after you factor in the tax rates that they'll charge you. And then finally, money market accounts. They earn some interest from higher minimums typically are going to be necessary. There's typically limited withdrawals that you can take from these money market accounts. They'll limit you to like 5 times a year, or can't take more than 10% of your money out, that sort of thing. Now there's one more option for liquid cash, and it's high cash value, dividend paying, whole life insurance. That's a mouthful, just saying that. So I'm going to just call it bank on yourself for short. High cash value, dividend paying, whole life insurance, we'll call it bank on yourself. This is very different than what Susie Orman and Dave Ramsey love to hate on their radio shows and TV shows. Typically, the cash is growing at a much faster pace. They are supercharged with specific options or riders that are added to this type of life insurance. And the commissions, when we design these policies this specific way, are cut typically by like 70%. So if you're ever wondering, if Dave Ramsey is saying, hey, all whole life insurance is terrible and you should hate it, and he gets you feeling that disgust feeling, I'm probably going to agree with him on much of what he's saying for most whole life insurance, because most whole life insurance is not designed this specific way. So either he doesn't know about it, or he doesn't want to make this exception, this kind of whole life insurance.
Yeah, Dave is not an exception guy.
No.
I've never heard Dave give exceptions.
There's no nuance, is he?
No, that doesn't mean he doesn't do it. I've just never heard him say it. But this is one of the things that when I was promoting this event, and thank you guys for being here and going through my relentless promotion for the last month to get you here. But I got a lot of pushback on this event from people who already have whole life policies. It was very interesting. Well, I've already got whole life. Like, okay, okay, so do I. Like, but do you have the right one?
Right.
Do you have this is all about properly structured whole life. This is not just going to your average State Farm agent or your Mutual of Omaha or Northwestern, any of those guys, because they can do great things, and just say, give me a whole life policy because Mark said it's a good thing to do, even though Dave's, that's not what we're talking about. There is something completely different about the structure that if you don't do right, it's not going to work. And if you heard the guy in the radio show talking to Dave, do you hear what he said? How many years did he say it was going to take to get his money back? Do you hear what he said? 7 years.
Yeah.
7. If you structure this right, and I'm not the guy, like I don't sell insurance. And that's another thing I got this morning. The guy selling whole life insurance telling you about whole life insurance makes sense. Like, well, first of all, it does make sense for if that's what I sell to tell you to buy it. Otherwise, I'd be out of business.
Right.
That's dumb. Second thing is that I don't sell whole life insurance, right? That's his job. That's what he does, and there's other people that can do it. But the thing is, this is completely different than just buying whole life insurance. And if you structure it correctly, again, I don't do the structures. You can get your money, you can access your money within 90 days.
Yep.
This ain't something you have to lock away for 7 years and wait for dividends, which is why Dave had that look on his face, because that does sound dumb. I think we'd all agree that if that's if that's what's being built for that guy on the radio,
You bet.
that's dumb. You can do it a whole lot better and a whole lot faster, which is what we're going to talk about.
Think of the oldest, worst, least efficient car you can imagine. Got it in your mind? Whatever it was. If I just told you, hey, all cars are bad, and the only thing I ever described was your 1970s Chevy whatever, then I probably would convince you pretty easily, right? But is it possible that there are more kinds of cars out there than the one car you have in your mind right now, whatever that might be? And it's true with whole life insurance too. If all cell phones were designed the old-fashioned way, back when we had the 1980s brick against our face, then Dave Ramsey's point would be true about whole life insurance. He's describing whole life insurance that I haven't really seen issued in this country in 40 plus years. It's almost like he's got the same slides and talking points from decades ago, and he's got such a great marketing operation that he's got a battleship he's really pushing forward, and he really can't make the exception for this particular design. It'd be sort of like saying, hey, all cell phones are bad because they used to be bad in the 1980s. Meanwhile, we've had things like the iPhone and whatever come around to make things a lot more nuanced. It's all in the engineering.
That's right.
It's all in the engineering. Okay, so let's take another look at this then. So why dividend paying whole life insurance? Again, I'm a certified financial planner. Why the heck am I spending all this time talking about boring old whole life insurance when we could be talking about more fun, exciting, sexy things, right? So I cannot, the more I look at this tool, the more I can't look away. It's a very compelling strategy for not just your basic run-of-the-mill business owner, but it can be done for the complex designed solutions for business owners right down to the average American just trying to help save for their kids' college and their own retirement. So first of all, they have a cash value, not just a death benefit. These policies are not just life insurance. There's also not just a death benefit, there's a living benefit as well. And that living benefit is called cash value. Cash value in these policies, whole life insurance, grow guaranteed every single year. They grow on a predictable and guaranteed pace every single year. There's a contract that you have with the insurance company, and they cannot wiggle out of that contract. They must provide you an increase of your cash every single year. In addition, that return is going to typically be better than other cash equivalents in our portfolio. So this will beat the savings accounts, certainly the CDs, the money market accounts, but it's not going to be, double-digit rates of return. That's not what this is. All right. In addition, like you said, you can get access to the money as soon as you start your policy. Within a few weeks of starting your policy, you've got liquid access to the money that you can use for any reason. Including your business, including your personal life. There's no prohibited transactions. And of course, it is life insurance, so you can leave your family more than you've saved for them automatically, just because of the nature of what this product does. The only other way I could be immediately wealthy after I die is if I somehow became a famous painter, because those are the only other folks that I'm aware of that automatically get wealthier after they die. And then finally, you can become your own source of financing. Let that sink in for a minute. If you could become your own source of financing, fire your banker, and reclaim that function in your life, what would change about your life right now? If you paid yourself the payment that I was paying to Sally Mae, what if I could pay myself? That was the spark that started me down the pathway of, hey, wait a minute, maybe there's something to this. And in fact, my professor, when he sat in my living room to tell me about Bank on Yourself, again, I was at first very skeptical. I had the furrowed brow, feeling the disgust that Dave Ramsey had planted in my brain about whole life insurance. And then my professor told me, Mark, is it possible that Dave Ramsey could be wrong about something? I still remember him saying that question to me. It haunts me because that question cracked open my closed little mind and got me down that 7-month exploration phase of really discovering what's true and what's just something I've been told. We've been told a lot about money, especially in this country, but have we really done the math on that? That's what we're going to be spending the rest of our time talking about today.
Well, and I would say too, on that last part, this is what we call Bank on Yourself, is you can become your own banker in essence. Once your policy is funded, if everybody in here for the most part are business owners, as far as I can tell, people that are watching online, this is the Entrepreneur Master Series. I would imagine most people are entrepreneurs. You need access to capital. And what's more fun than going down to the bank and handing them your financials and begging for money?
Right. Yep.
Everything.
Yeah.
Everything's more fun than anytime you have to go to the banker and ask for money, they're going to say, all right, we need a stool sample. We need your third kid's DNA records.
Yep.
They want everything.
How many kidneys do you have? Let me have them.
Yeah. And here, the worst part about that is, as we all know as business owners, you can have a great up and to the right trajectory, but on paper, the banker only sees that bottom right-hand number. And sometimes with that bottom right-hand number has a negative, or it's in red, or it's in brackets. You and I aren't scared of that. Like, we understand how business works. We get it. But the banker's like, hey, you ain't making any money. Like, dude, come on. Like, on paper, I haven't made money in like 8 years.
Mm-hmm.
Okay. On paper, like negative $1 million every year. But that's okay. As Trump said, and famously in the debate against Hillary Clinton, it makes me smart. And he's using the tax code to his advantage. Well, can you imagine going to stop ever having to go to a banker and explain the bottom right-hand number being negative? And you could just call your insurance company and say, hey, I need $100,000. I'm investing in a new piece of real estate, or I'm buying whatever. I need $100,000 for my business. And they don't ask any questions. They're like, where do you want me to send the money? That's it.
Yeah.
And in 2 or 3 days, you have the money.
Yeah.
That is freedom.
That's control right there. Yeah. You get to use the bank for your convenience rather than them using you for their convenience.
Yep.
That's a big deal right there. I'll tell you a very quick story. There's a client that he had $1 million line of credit with the bank. $1 million line of credit. Used it all the time for operating and doing trips and inventory for his sales guys and gals and all that. Inventory purchases, equipment purchases. $1 million line of credit at the bank. And guess what? The bank calls him up and terms his loan. That just means they're getting out of his business. They're exiting his business, meaning, gun to his chest saying, pay us up. Give us our $1 million back. And now he can't run his business anymore. And he's furious, scared, angry, disgusted. He said, Mark, I never want to darken the door of a bank ever again. So over the next several years, he pumps money into one of these policies, gets $1 million of cash value in his policy in 5 years, which is the term that the bank agreed to get him out of their business, out of his business. And now he's his own line of credit to himself. And it's an increasing line of credit every single year on a guaranteed basis. And this gives him full control over his business. Whereas before he had a partner with the banker. And by the way, he had to hire 2 people full-time just to work on banking book reports and, bookkeeping and compliance measures with the bank. So yeah, he had the interest rate on his line of credit, but he also had the salaries he had to pay those two people, which is really a banking expense. You know, full time just to cover the compliance measures and paperwork of a bank. So these are some of the hoops we have to jump through. Like you said, get a stool sample and you know, collateralize our kidneys and things like that. So,
well, I had a very similar story. I think it was the year, I'm almost certain it's the year I started my first policy. It was on the heels of a banker calling mine at $1 million line of credit. By the way, this room is the training room for one of the companies I own, and we use this for these events. But I had $1 million line of credit, and the banker called it with no explanation of, well, I could tell you the explanations, but it didn't matter. And what am I going to do? Like,
yeah.
and that from that point forward, I said, I will never do this again.
Mm.
Now, do I still have $1 million line of credit with another bank? Yeah, because I think it makes sense. If you can get it, why not?
Mm-hmm.
I mean, get it when you can't. Get it when you don't need it.
Exactly.
Because when you need it, they ain't giving it.
That's the only
way
time they
also
offer the money.
It always works that
Mm-hmm.
way.
That's right.
But that started my journey. It was about the same time I started learning about banking yourself, and I said I got to do this. And of course, now I still have bank problems because I'm in business, but it's not nearly as bad as it was.
Love it. Love it. Yeah. Mark Twain is the guy who said, a banker is a fellow who will lend you his umbrella when the sun is shining, but wants it back as soon as it starts to rain. And that has been true for the last 100 years since he said it.
Yeah. And if my banker's watching, not you.
Yeah, we like you, man. Yeah.
Tim's awesome. Tim
Yeah.
and Dina, you guys are great.
Well, again, I'd say someday you'll get to a point, all of us can get to a point where we're using the bank for our convenience, and we can essentially drop them off at the curb whenever the time comes. And one more thing too, if you're your own source of financing, can't you be everybody else's too? So when the rest of the world can't find money and the world is in a tight bind like it's going to be, you know, we're not done with volatility yet in this world. Everyone else comes to the bank adjacent now asking for money.
Yeah.
Now you're collecting interest
Not just
payments.
my kids.
Yeah, right. Bank of Dad. That's it. Love it. Okay, ready to keep rolling?
Yes.
Let's do it. Okay, so more modernized for your business. This says supercharged cash values, typically between 8 and 40 times as much cash as old-fashioned whole life would have. This is with mutually owned companies, not stock-owned companies. Dave had a lot of misinformation in there about that. Gains are locked in. When you get a guaranteed increase of your money, last year, the markets were down 20%, depending on what index you're following. The S&P was down about 20%. NASDAQ were down about 30%. All of our clients hit all-time record highs last year in their policies. In a world where the bonds were down, stocks were down, real estate was faltering, supply chain shocks, COVID craziness, and all of our policies hit all-time record highs. That's a pretty cool place, not just to survive, but to thrive in any economy. So gains are locked in. So when you got a gain last year, you get to keep it this year, and then they throw more gains on top of that. And on top of that, that's true compound growth. We talked about the volatile market versus a straight line going up in one direction. This is a straight line, not something that's going to go jumping up and down, bouncing around. And of course, one of the key pieces that you brought up, Jason, is that you can borrow from your policy and it will continue to grow as if you hadn't touched a dime of the money. Now, I don't know anything else that can do that, where it continues to build and grow even on the capital you borrow, like you hadn't borrowed the money.
Can I do an illustration on
Oh
that?
yeah, sure. Yeah.
This is something I don't know if I came up with this or somebody else showed it to me. You hold this for just a second. So pretend that doesn't exist for a second. So here's
It doesn't exist.
Here's $100. So here's $100 bill. So if I get $100 and I go say I want to spend this $100, and I give it to Justin over here and I spend it, it's gone. Now I have the thing that I exchanged it for. No, not yet.
Yeah.
But if I give this $100, I spend it on a car, an investment, whatever it is. I have the thing, but I don't have the 100 anymore. But here's the beauty of whole life insurance. It's properly structured, of course. Is let's say Mark is my whole life insurance company. I deposit it with him. I've invested that in my properly structured policy. And then I say, I want to buy that thing. So he's going to hand me 100, but he's handing me a different 100. My 100 is still there. Now I can go buy this thing, and I have the thing, plus I still have my 100. And that will continue to grow. And as if I never touched it.
That's right.
It continues to grow. Now, the cool thing is if I take a $100 loan from that $100, That 100 is still there. I've got the loan, right? This is borrowed money against my policy, collateralized. You could explain that later. And I go buy I invest in an appreciating asset, a piece of real estate, a business, whatever. I not only have this 100 invested there, but it's growing there and it's growing there. It's growing in both places. That's why you should do this. One of many reasons. And I'll give you a real life example. Can I have 100 back?
Yeah, if you say please, yeah.
So I'll give you a real life example that just happened to me. So I sold a used car that I had, and I'm buying another used car, and the used car was inexpensive, and it was $14 grand. I sold it for $14,000. Not a lot of money. Now what I could have done is I could have taken that $14,000. I could have taken that 14 grand and put it down on the new car that I'm getting. It came in yesterday. I'm going to pick it up Friday or Saturday this week. Right? And guess what would happen? I would have spent the $100 once.
Yep.
But what I did is I called Mark. I said, hey, Mark, I just sold this car. I'm about to buy another car. I want to put this 14 grand into policy and then borrow it right back. Just, yeah, do it. So we did it, made the payment, took the 14 grand, put it in my bank account, transferred it to the insurance company, and then immediately asked for the 14 grand back, which I'm going to take to the dealership on Friday and give them 14 grand to put down on the car. So that 14 grand is permanently in that policy and going to continue to grow forever.
If that sounds like magic or voodoo, please wait. I'm going to show you the numbers. It all works out. But it's important to remember that anyone with a mortgage, raise your hand in the room if you have a mortgage. Yep. We're already doing this with our houses. There's no difference, except this offers way more guarantees than the mortgage or your house value.
We have a question online. So Justin, we have a question from the online audience. Would you just read it out loud for us?
Is there a name of your product such as premium financing or certain INS company or broker?
Okay. Yeah. Okay. Great
Repeat
question.
that question so that people online can
Okay. So the question is there a name for your product such as premium financing or certain insurance companies? Yes. Yeah. Not all insurance companies offer what we're describing right now. It's a great question. Very few actually do. There's about 1,000 life insurance companies in the United States. I'd say maybe less than a dozen design the policies the specific engineering. You know, how many technology companies are there? There's only one Apple and one Google making cell phones right now. So that, you know, there's a lot of examples of insurance products that I would not recommend and do not satisfy all of what we're talking about here. As far as premium financing goes, that's a very different conversation. I also typically don't recommend that, except in very rare estate planning purposes, which we can get into that, what that is. But
yeah, we do that in Q&A.
yeah, okay, cool. Great questions. All right, so you want to make sure this is a company where you can access the cash value for any reason. There's no red tape or prohibited transactions. You get to control the banking function in your life, and when you do that, you basically win. I can tell you from doing this myself personally for over a decade and working with over 1,000 clients, when you control the banking function in your life, the rest of the story in your financial life just gets easier, and you typically win by default. Like you were just saying, when you control the banking function, you get to decide your fishy's temperature in his aquarium. It's not some banker dialing up the heat. All right, your airplane is now flying with a tailwind. You're actually paying yourself what you might have been otherwise paying a banker, a credit card, a company, a mortgage company, a finance company. These are called non-recourse loans. So this is different than your mortgage, right? If I stop paying on my mortgage this month, what's going to happen eventually? They're going to come with the battering ram, right? Get me out of that house because it's a recourse loan. They got my house as collateral. Well, this is a non-recourse loan, meaning there's no required repayment plan when I decide I want to borrow from this policy. Now, I recommend paying back the loan. It's not required. If you never pay off the loan, they'll simply deduct it from your death benefit when you pass away. So I do recommend paying back the loan. Why would it make sense, Jason, to pay back the loan?
Well, because it continues, you continue to have access to that money.
Yeah, you might want to get another car someday, right?
Exactly.
Yeah.
Yeah.
So using this money over and over again, it kind of feels more like you're recycling the money than just throwing it away on your, most recent purchase or whatever. And then, of course, the policy grows the same whether you borrow from the policy or not. All right, so what are some of the downsides? We've been pumping this thing for a while. Let's talk about why we'd want to dump this thing. Obviously, there are insurance costs. We cannot avoid at least some insurance expenses on these policies. If you don't want to have any insurance expenses, there's a nice savings account at the bank they'd love to sell you, okay? The next consideration, I don't know if this is a downside, but it's at least something considering, you need to be able to save. You have to be able to live within your means or have some money already saved in order to start one of these policies. All right. You'll also never get in a whole life policy, there's never going to be the wildly wonderful, great rates of return that you might get in the best years of the stock market. When the market's surging, you're going to have that fear of missing out sometimes too. So this is steady, predictable, some say boring rates of return. And it's typically, again, a long-term saving strategy. So it's not a get rich overnight kind of plan. If that's your jam, heck, go find yourself a new meme stock or find yourself the next Bitcoin or whatever. This is going to be steady, predictable, boring place to park your savings in between your business deals and investments. So I would also say it's certainly not going to be, it's not something you should count yourself out on if you feel like you can't save a lot. Again, I had problems saving because I was in debt up to my eyeballs when I started my bank on yourself journey. But I sat down with a competent professional who said, hey, Mark, rather than overpaying on your student loans, the super low interest student loans that I had at the time, why don't you redirect your overpayment, what Dave Ramsey calls the debt snowball payments? Why don't you put that into your policy instead? And that allowed me to open up my policies right away and begin building an asset right away. I was just throwing money into the debt hole and losing all that money forever. What my advisor that I met with sat down and said to me was, hey, Mark, redirect that overpayment, throw that into your policy, build that asset for yourself, then borrow against the policy and wipe out your debts one by one. We've since trademarked this. It's called the debt snowbank method. You like it? All right. So now I was hoping Dave Ramsey would be walking in the room right when I said that. All right. So don't do this for overnight wealth. I can't emphasize that enough. This is a slow burn. It's the back of your oven. It's the regular, predictable, but over time, very exciting savings strategy. I just sat down with somebody yesterday for a 6-month review like I do with all my clients. We looked at his policy. Every dollar he puts into his policy this year will be 40% more money than he has today. So if you put in 10 grand, you got 14 grand. If you put in 100 grand, you have 140 grand. This year, in his new contributions, we've got that kind of growth happening. So it's boring at the beginning, but like a tree ring, it gets bigger and bigger every year. Like a compounding growth machine, like a supernova in the stars, this thing gets more and more efficient every single year.
This is why I said this a lot in my promotions of this event, is I'm 48 and I only started this 4 or 5 years ago. And had I done this in my 20s, I would have literally 8 digits of money available to me in cash value,
Awesome.
20 or 30 million. Maybe.
Awesome.
But because I would have been using it the way I have access now, but I don't have that. Because I started much later than I needed to. So as I'm looking around the room, we got various ages of people here, a lot of people online watching this. If you're in your 20s or 30s, like, you need to figure this out right now, because by the time you're my age, you're going to have millions and millions of dollars in cash value that's available to you.
As you guys are seeing this and you're in the room, write down your questions so you don't forget. If you're like me, the question's going to go right out. So write it down. We're going to have time for questions at the end. Folks online, feel free to put it in the chat, and then we'll make sure we collect. All right. So the biggest risk, though, the biggest consideration is the wrong advisor. Okay. So I've seen thousands of examples now, literally thousands of examples of people who thought they had a policy. Oh yeah, Mark, I got one of those infinite things, those family wealth banking things, those cash flow banking, legacy wealth banking, whatever it is, right? All the nicknames you can possibly imagine, some of them compliant, some not so compliant. The biggest problem is the wrong advisor building these things. Typically, the policy can be designed with all the right wording, but the wrong design. Unfortunately, what the advisor doesn't know can hurt you. And unlike Unlike, well, much like cell phones, if you get the wrong cell phone design, or if you get the wrong cell phone engineering, there's a lot of engineering that goes into this little machine in my pocket here. A lot of engineering. All I have to do as the user is swipe, and it works. But there's a lot of detailed, specific engineering to make the whole thing happen for me. And if it's not designed properly, if Apple didn't know what they were doing, I just have a brick in my pocket, pretty useless. I've seen policies with unnecessary fees, seen them grow way too slowly. I've seen there's an undue risk baked into the policy itself. It might penalize you when you go to borrow from the policy. It'll stop its growth, meaning when you borrow from it, it'll stop growing. I had a guy just the other day, he's a farmer. He has $800,000 in 4 different policies from a mutual life insurance company, has its whole life insurance. It had paid up additions. It all looked great, except we found out that it's something called direct recognition loans. I mean, nothing to most people, but what that does functionally is that it stops the growth. When you borrow from the policy, it stops growing when you borrow from that account. And that is a deal breaker. Like, what's the point in doing all this insurance stuff if I can stop the growth of my money by just withdrawing it from a savings account? So why go through all the rigmarole of insurance? I can just skip all that mess and just use a regular savings account. If I want to stop the growth of my money when I withdraw it from a bank account, that's easy enough. So one little feature, one little sentence in your contract can really change everything in terms of the use and purpose of this. So you only want to work with the Bank on Yourself Professionals crew. They are a certified and authorized program, the only certified authorized program that has continuing education credits, that forces us into masterminds and regular coaching and success training. There are a number of, there's 400,000 life insurance agents in the United States. Doing the math on that, that's about 1 for every 800 Americans. So if there were 400,000 heart surgeons in this country, 400,000 heart surgeons, and you desperately needed heart surgery, would you just go to the nearest local heart surgeon in your town? No, hopefully you would go to the very best. You would go to the one that had the certification, the ongoing training, the rigorous training requirements, and more. So you really want to make sure you're working with someone who has that ongoing training. Okay, so this is the fun part for me. That's all prelude. I want to get to the fun part, which is where we get to, if he's going to bash Bank on Yourself, I want to go back and bash some of what he said in detail. And so he says a few things. First of all, what he gets right. The only thing he seems to understand about infinite banking or Bank on Yourself is this thing called stock companies versus mutual companies. And he says there are 2 types of life insurance companies. There's stock and mutual. Stock-owned companies are companies that are owned by public shareholders. So, you can buy their stock on Wall Street. Now, we talked earlier about how you get quarterly earnings, and that's sort of the focus of Wall Street. Life insurance, I don't know about you, but I want to live more than 90 days. That's my plan. That's my long-term plan, to live more than the next quarter. I don't want an insurance company holding my contract where they're chasing this quarter's returns. I would rather a mutually owned life insurance company that is owned by you and me and all the other policyholders. That to me makes sense because my interest is aligned with the company that I co-own. It's more like a co-op. If you guys are familiar with how some co-op grocery stores work and that sort of thing, you're an owner like everybody else in the company that we all own together. It'd be like you and I owning a mortgage company together. If you and I owned a mortgage company, let's pretend for a minute, and let's say that, okay, I need a mortgage. Jason, am I going to go to any other bank in town, or am I coming to our company?
Our company.
And if I get a mortgage from our company, now I owe the company some money, right? Are you going to want me to pay that loan off?
I am.
Yep. Who benefits as I pay that loan off?
We both do.
We both do. Yeah. Why do we both benefit?
Because we both own it.
Yeah. So we both benefit when I pay back the loan to the company that we control together. All right. We'll come back to that little analogy in just a minute. The next thing Dave Ramsey says is when you're the owner and the customer, it's a ripoff. Now I want you to think about that for a minute. When you're the owner and the company, when you're the owner of the company and you're also the customer of a company, where's the only place they can get profits? Well, you, because you are the sucker that owns a company where you're also a customer. All right, now we just had that little interchange, right? Well, all right, maybe that's true. Is that really a ripoff? Where does the insurance company make their profits? Is it really just coming out of my pocket? Is it going from one pocket to the next? If you and I owned a grocery store together, let's use that as another analogy. If you and I owned a grocery store together, would I go shopping at somebody else's grocery store, or would I come to ours?
Come to ours.
Would you charge me, or would I get to walk out the back door with my can of peas?
Well, depends on the agreement, but probably going to charge me.
In fact, you know that I'm a captive customer, don't you?
Yeah.
Because you know I'm not going to, what's the local, we got
Publix or
Piggly
Kroger.
Wiggly? Yeah, okay. My family's from Alabama, so I know Piggly Wiggly. So would I be going to any of these other grocery stores, Publix or whatever? No, I'd be coming to ours. So shouldn't you charge me a little extra? Because I'm a captive customer around here.
I don't know about that.
And I hope you are, because you're my business partner. I want you to charge me a little extra, especially charge my cousins, because they really need the extra grocery love over here. So definitely charge me a little extra. Who does that benefit whenever you charge me a little extra?
Well, both of us
We
again.
both get profits. Exactly right. Now, that's a little fun, but this is a specific portfolio layout of where the mutually owned life insurance companies put the money. It's not just going from my pocket to theirs back to mine again. They put a lot of their money in fixed interest assets like corporate bonds, some real estate. But again, they are us. They are us. We co-own the company together. And there's no other people looking to make a profit. There's no private jets leaving from these mutual life insurance companies. Believe me, I've been to their headquarters. I've seen their cafeteria food. They are not making profits like mega profits. There's a reason why the movie is called The Wolf of Wall Street, not The Wolf of Insurance. All right. So these mutual companies are not in it to there is no they. They are making a profit. They've been profitable for over a century. They've delivered the profits to you and me, the policy owners, for over a century. But it's not like they are ripping off their policyholders. If it's mutually owned, we own the profits together. And I just want to say that again. They've delivered profits, i.e. dividends, to the policyholders for over a century. That means we made it through COVID. We made it through 2008. We made it through the banking crisis of 1980s. We made it through the Great Depression of the 1930s. We made it through the last pandemic of the Spanish flu. All of those years, and they consistently kicked out profits on top of their contractual guarantees. Let that sink in for a minute. What would that do to your financial life if you had that kind of predictability? So the next piece to this is,
We do have a question from
Yeah,
online.
sure.
I don't know what the question
Cool.
is. Justin, what's the question?
What financial credentials does Dave Ramsey hold?
And
What-
so say the question out loud. So
yeah, what financial credentials does Dave Ramsey hold? CFP, other? The only financial credential he holds is radio license. That's it. Does not have a license to give you advice. He used to have them, maybe, when he was an active financial advisor 40 years ago. But he is a infotainer, and that's okay. That's his role in life. God's put him on the earth to be a radio host. He is not a financial advisor. He has no stake in the outcome of your plan that you follow as a result of taking his advice. So let that sink in for a minute. Great question. Great question. Okay. Next piece to this puzzle. He says, you're paying interest on your own money. What fool would do that? You're paying interest on your own money. Again, he loves disgust. So let me kind of walk through what that is. Are you really paying interest on your own money? Here's an example of a bank on yourself designed whole life insurance policy. And the numbers might be small, so I'll just kind of point these out. This is somebody putting in $1,500 a month. Now, first of all, why in the world Dave Ramsey would be screaming, pulling the last 3 hairs out of his head if he saw someone putting $18,000 a year into a whole life policy? Believe me, I'm just as bald as Dave is, okay? I realize grass does not grow on a busy street, okay? So I'm cool with Dave in terms of his bald head. I'm good with that. But $18,000 a year is a lot of money to put anywhere. So is that a good deal? Let's find out. So in the first year, he's got $11,000 of cash value and a $648,000 death benefit. That's in year 1. So we can see very clearly that the policy has a cost. He put in 18 grand. He has 11 grand in the first year. Second grade math says that's about a $7,000 insurance cost. Does that make sense to you
Yeah.
too? Okay. So 7 grand, where did that money go? Oh yeah, it went to cover that potential loss. If he was to die in the first year, this guy, his family would get 648 grand. He spent 7 grand for that eventuality. All right, so by year 3 to year 4, is that right? Yeah, 3 to year 4. Look at the number there. It's in yellow. It says $40,000 is his cash value. And the following year, it went up to $58,600. Now, my second grade math says that that goes up about $18,400. Does that look right to you
Yep.
too? 18,400. In year 4, what was the premium he paid in year 4?
18.
So he put in 18 grand. The cash value went up by $18,400. Let that sink in for a minute. He put in 18 that year. It went up by 18,400. Who was paying who that year, Jason, for the life insurance?
It seemed like a in and out money. It's like,
Yeah.
It's free money.
Yeah, he put in 18. The cash value grew by 18,400, and he has a death benefit of over 800,000 bucks. Wow, that's pretty cool. So the net expenses are done by about that 4th year, 3rd to the 4th year. It costs something for sure in the first few years, but by about year 3 to 4, those costs are gone. And from then on, the policy continues to grow more than he contributes to it for the rest of his life. Notice how the policy is getting more and more efficient as he goes down the page here. And as we go down the page, go all the way down, he decides at some point in his future, let's use age 70, for example, he's going to stop funding this policy, and he's got $1.2 million at age 70. $1.2 million in cash value. That's liquid money he could be using, and he decides to use it for retirement, and he pulls out 60 grand a year. Pretty cool. All right, now remember that $1.2 million number. Just keep that number in mind for a minute. Okay, now let's look at the same exact plan. Now, though, this gentleman is going to start borrowing from this policy. Is he going to pay interest on his own money? Is he going to break compound growth? Let's find out. So again, same plan for the first 3 years, but now in year 4, he takes a loan. Maybe he's buying a real estate property, down payment. Maybe he's buying a car or a motorcycle or whatever else that he wants to buy. Maybe he's fixing up the kitchen. Maybe he's sending his kids to college. Maybe he's paying off his student loans. In any way, he borrows from the policy 35 grand. Let's say he buys some cars. He does that same thing over and over again, pays back the loan, borrows it out, pays back the loan, borrows it out. It's like recycling the cash. Does that 6 times over his life, and at age 70, what is his cash value? Oh, wait, we've seen that number. Where have we seen that number before? 1.2 million. That's exactly what he would have had he never borrowed the money. Jason, back to your idea about the $100. This is his money growing even on the capital he was borrowing to buy those cars, vacations, business equipment, whatever else. This is his money doing 2 things at once. All right, so that's the 1.2 million he would have had he never borrowed from the policy at all. Now, this is really what changed my mind about Dave Ramsey. So what Dave teaches us is stay out of debt. At least that's what he taught me. Baby step number 2, stay out of debt. Get out of the debt, use the debt snowball. When you don't have anything to your name and you need a car today, the only way you can get that car today and you have nothing saved is to go into debt. And then you have to start what? Making payments. Climbing your way up out of that hole you created for yourself. And then 5 years later, you finally get to call Dave Ramsey and scream, I'm debt free. And then what? Now the car is 5 years old. Kids are kicking you in the back seat. The French fries are really starting to smell in the seats there. So what do? You go get another car. You just repeat this process over and over again. You live your whole life on that hamster wheel of debt payments. Who wins in that scenario? The bank does. The only other option is to save, and then pay cash. The Dave Ramsey model. Save, pay cash. I call this the sugar high of finance. It's the sugar high of finance because you feel great for about 15 seconds when you pay cash and you get the title of that car, but now you have that empty feeling in your bank account. And all the compound growth that you would have earned on that money is now lost forever. This is called opportunity cost. So when you pay cash for something, the sticker price on that car might be 40,000 bucks, but the true cost of that car is whatever 40,000 would have continued to grow to had you just left the money in your bank account and just left it invested and not bought the car. Is that?
Yeah, this
check out for you?
is one of the things that once you get your head wrapped around this, I know Dave is always talking about paying cash for everything. And generally cash, I mean, you get good deals, you pay cash. But when you pay actual cash, where you're doing this above the line here, you know, you had zero, you save the 40, and boom, you deplete the 40, you're back to zero, you pay cash. You're right. You've lost all the potential that money could have grown to.
Yep.
And this goes back to my little example that I'm doing right now about buying this new car of mine. It's only 14 grand. I sold a used car. It's only $14,000. What difference does it make, Jason? Just go put the 14 in the car. No, that's $14,000 worth of cash growth that I'm going to get for the rest of my life. So I'm going to put it in the policy, which I know he's going to explain in just a minute. But paying cash for things is not a good idea.
It's a sucker's game.
Now paying cash, like physically, is pretty cool because you can walk into the car dealership like I'm going to do and give them the money for the vehicle and finance a little bit. But like I give them money for the vehicle, but I'm not actually paying money out of a savings account and losing growth potential.
That's right. Yeah, you're still walking into the dealership with a check in your hand or whatever to buy that vehicle, but the dealership doesn't necessarily have to know or care that money happened to come from your policy first.
Exactly.
Is that right? Yeah. So when you use a policy, it continues to compound and grow. You lift off from $0. You know, when you use your policy, you borrow against yourself, and it continues to compound and grow, as you see on the slide there, as if there was no loan. So your policy continues to compound and grow as if there was no loan.
We have a question coming in.
Yeah, sure.
So we got another question coming in from online. So Justin, what's the question?
That 7K cost, is it tax creditable?
Oh, good question. Well, tax
Say
credit.
the question so the people online.
Yeah, okay, thank you. So the question is, the $7,000 insurance expense, is that tax creditable?
And that's from that example you were given a minute ago with
Yep.
the chart.
The short answer is no, it's not. It's an expense. It could be a business expense, possibly, if it's inside your business. So let's talk afterward about that. But typically, the policy it's more like a Roth IRA in how it's taxed. You put the money in after tax. The policy grows with no taxes due every year, and you can get access to the money totally income tax free if it's designed the proper way. Great questions. All right. He says, you need a real financial advisor, not some insurance broker trying to sell you a load of manure. I love Dave's, again, he's got the string of disgust. He's pulling on that string. So let's find out if this is really a load of manure. Here's an example of a guy named Dan, real Bank on Yourself policy holder. All right. Before he had started Bank on Yourself, this was his net worth. This is literally a picture of his net worth. He took the numbers off, but this is what his net worth did. He charted it every month from the year 2000 to the year 2009. And you can kind of see basically just bouncing around, not really going down, not really going up. He's had tremendous drama with the stock market bubbles and crashes and everything. But in 2009, he opened up his very first Bank on Yourself policy, and look what happened next. What a picture. That picture is worth 1,000 words. His net worth tripled because he had contractual wealth in his portfolio. Do you have contractual wealth or just paper wealth in your portfolio? What would it feel like to have a contract with your financial future? That's what a whole life contract is. It's a contract with your financial future. He now has several policies that build and grow on a predictable basis every single year, no matter what happens in the stock market. So is that a load of manure? I don't think so. Next up, they confiscate your cash value. I love that he uses the word confiscate. What a loaded, dramatic phrase, right? They confiscate your cash value, he says. Here's an example of a real life policy. Actually, this is one of Pamela Yellen's policies. She put it up online for everyone to see. Pamela Yellen wrote the book, The Bank on Yourself Revolution. She coined the phrase bank on yourself. So it's small numbers. I'll try to quickly explain this. She had a brand new whole life policy. She opened it in September of 2002. Now it's the first year later, 1 year later, she now has a policy statement in September of 2003. Again, this was in the tech burst when the markets were down. And her cash value started at $0, but at the end of the year, she had a cash value of $2,937 there. 1 year later, this proves that the financial experts are wrong. Dave Ramsey would say, hey, you have no cash value in the first 2-3 years of a whole life policy. Well, this is a policy that does have cash value, clearly showing that this is something categorically different than what Dave's talking about.
Yep.
The next example is he says, hey, they confiscate your cash value. When you die, all you get is the death benefit. He likes to say that a lot. Let's take a look and see if that's true. This policy started with a death benefit of $200,000. $250,000 is the original death benefit on this policy. Started in 2009. Started in 1992. So in 1992, death benefit was $250,000. Fast forward to 2009, and the death benefit is now $390,000, and she has a cash value of $128,000. Okay, wow. So let's take a look at what happened here. This is 2009. Anybody remember what was going on in the markets?
Mm-hmm.
Yeah, markets were plunging. S&P was off 40%. Her policy grew by $12,000, but she only paid in $5,000. So that's 2.5 times as much as she's paying in. That's 250% an annualized contribution in a year where the markets are falling apart. And the policy's death benefit is $390,000. So let's do the math on that. He says they keep your cash value when you die. Let's do the math. $250,000 was the original death benefit. The cash value was $128,000. But the death benefit, if she was to pass away that year, is $390,000. So the bottom line is, when you pass away with one of these policies, your family gets the original death benefit plus the cash value plus even more because it's designed this specific way. Okay. All right, I'm almost done. I think we're going to have some time to wrap up here, but this policy is another example of what he's talking about. As you can see, the death benefit starts at 1.7. It grows to 3.9, which is more than the cash value you pay in. And a lot of people say, well, wait a minute, Mark, those costs are outrageous. Well, let's take a look at the costs. You put in $40,000 in the first year. That's a lot of money for anybody putting it anywhere. At the end of the first year, you have a cash value of $26,900. That means you have a cost of $13,000. In the second year, the cost went down, didn't it? You put in another $40,000 and it grew by $30,000. That means you have a cost of $10,000. That's our cost in year 2. So it's getting more efficient. You can kind of see that happening. By the third to the fourth year, once again, we now have a growth of $41,000, but you only put in $40,000 that year. So like we said before, the net expense is basically gone by about that third to the fourth year. So our total cost for this policy, if you were to total it all up, is $27,000. Is that expensive? I don't know. The total dividends in just year 9 exceeds or almost exceeds your entire expense. Let that sink in for a minute. These dividends that Dave Ramsey says is just returning your own money. You're just getting your own money back. Dividends from year 1 through 9 begin to exceed the total cost of your policy. So do you know anything where you can put money into something and it gives you more than you ever put into it? Sounds like a real estate deal, sounds like a business. In essence, this is sort of like owning a business. Not literally, of course, but you are a co-owner in the life insurance company that you have a contract with. Over the next 20 years, your dividends total $113,000. That's 4 times what your expenses were. So if dividends are just returning your own money to you, how did you get 4 times more than you put into it? So again, we're just breaking myths from Dave Ramsey left and right. This one was especially hilarious in his video. He says, everyone in the academic financial field or has a CFP thinks these policies are a joke. Oops. I guess I'm a certified financial planner. I don't know what to tell you, and I'm saying it's not a joke. All right, so it is the real deal. I own several of these policies myself. All right, and then this is a pretty awesome spot. He takes a little minute to say, hey, you really should just get my Xander Insurance term quote over to you. So this is his own chance to have a commercial break, I guess. He has his biggest sponsor is a term insurance company. So as I like to say, if you ask a barber if you need a haircut, you can bet what his answer is going to be, right? So is it just those big commissions? I don't know. I see our time. I'm going to go.
Yeah, let's go quickly
Past
because I want to
this
do
over
some
this,
Q&A and announce about next, and we got a giveaway.
You bet. So I'll jump to the punchline here. If you were to have commissions on a whole life policy like this one here at $1,000 a month, you'd pay about $6,000 of commissions over 29 years. Similar design in a mutual fund, charging you 1%, like he loves to talk and recommend, the advisor would get $113,000 of commissions. So which seems fair to you? Which of those seems right to you? Which one has any guarantees? Okay. Yeah. So he then tells you to ask the Holy Spirit if you should get whole life insurance at the end of the video. So I can't really.
Really?
Yeah, at the end of this video, check this out. He's like, check the Holy Spirit before you get whole life insurance. I really can't fault him for leaning on this, and I'm not going to, yes, check with the Holy Spirit before you should do anything with your financial plan. Your Holy Spirit is your financial planner first and foremost.
Well, I think good advice, but out of context,
Yeah,
right?
a little bit. Yeah, a little bit. Yeah. So let's kind of summarize. Da-da-da. All right. Again, every policy is going to be designed differently. There's not, one-time, one-stop shop here. This is not a commodity. It's a nuanced financial strategy. Each person in this room, each person watching this needs to have a competent professional do this right for you. Don't drop the entertainment. Don't get your advice from an edutainer. Work with someone who has your specific circumstances in mind and is obligated to serve you in your best interest, not just a radio host. All right, so as we wrap up, again, if you want to chat with me or one of my colleagues, Evan, it's great to see you, sir. Evan is a colleague of mine as well, lives right here in the Nashville area. If you want to chat with me or one of my colleagues, happily sit down with you to have a 30-minute phone strategy session. Go to bit.ly/mycall, bit.ly/mycall, and you can have that phone call scheduled appointment with me or one of my team members. We can talk about how this strategy might make sense or might not make sense in your situation. Again, it's a nuanced strategy, so we don't want to just cookie cutter this thing. And happy to hop off my soapbox and answer questions.
Well, Mark, thank you for doing that. We got some questions that came from online, and then we're also going to do Q&A in the room and have some giveaways. We're going to give away some books today for those of you who are here live and in person. Thank you for coming live. Justin, give us one of the questions from online.
Many policies only gain interest on the cash value after loans. For example, if you have cash value of 100K and you borrow 40K, then the interest can only be on the cash value balance of 60K. Are you saying that the policies you're talking about gain interest on the full 100K, even though you borrowed the 40K?
Yes, correct. So the question is, if you have he said, this person says, many life insurance policies, when you borrow from the policy, you'll only get the growth on whatever has not been borrowed. And that is a lot like a savings account or a brokerage account. You will only earn interest on your savings account if you don't withdraw from that savings account. So what this person is describing is a direct recognition loan. This is counter to a non-direct recognition loan. I like non-direct recognition because if I have $100,000 of cash value and I borrow out $40,000, my policy will continue to grow and earn interest on the full $100,000 as if there was no loan.
Yep. The direct recognition versus non-direct recognition was one of the first things that I learned as I was pursuing this, and that is a big deal. So, for example, if you have $100,000 invested in the stock market and you need 50, and you pull 50 out, that's direct recognition because now your stock market portfolio is only worth 50 because you now have the 50 over here that you're going to spend on something else. If you did it in real estate, you have a $100,000 piece of property, you could take a loan ostensibly against that 100,000 and take 50 out and go, and this is still growing,
right?
Not without recognition. So it's non-direct recognition. And then insurance, though properly structured, is also non-direct recognition. So you can pull that money out. It continues to grow. Like my $100 example, he give me 100, I can go spend it over here. That 100 acts like nothing ever happened.
Mm-hmm.
That's a good question. Do we have another one from online, or is that the only one, Justin? All right, got already answered. So live in the room, anybody got questions about this? We got about 8 minutes left in our time together today. I want to make sure we get plenty of Q&A time, and then I want to do a giveaway, and I got an announcement about our next event. Steve.
So is there, and I'll try and frame this the right way, I've got a couple of questions in this. So is there any reason to have term to fill in any of those gaps? Because my advisor had told me that. I also have whole that's structured in this way. Is there any reason why he would not have been coaching me on being able to utilize them that way as well?
Good question. So Steve, you asked a great question. You asked, is there any reason to have term insurance? And your second part of the question is, hey, I think I have a policy like this. What was the question related to that part?
Why is he not coaching? Why is my advisor not coaching me on being able to use that? As
Okay.
a bank
So-
to be able to pull out that value and utilize it?
So that second part of the question for those listening is, why didn't my advisor coach me to use my whole life insurance policy that he set up for you in the way that we've been describing today through banking processes and so forth? The first piece, term insurance. Yes, there's a place for term insurance. And a lot of people end up getting term insurance when they can't yet afford whole life insurance, or they need more than the whole life would provide. Our goal with whole life insurance, designed the Bank on Yourself way, is to get as small a death benefit as we possibly can. Then the term insurance is really just covering that for the family or the business. The nice thing is, if you get the right term insurance with the right company, you can even convert a whole life policy or term insurance to a whole life policy and have a new Bank on Yourself designed policy without going through another medical exam 5 years from now, 10 years from now, when the business is ready to do that. So term insurance has a place. Whole life insurance, again, there are hundreds of thousands of insurance agents out there. I wasn't taught this when I got my insurance license. I didn't get taught this when I even got my certified financial planner designation. You really have to seek out mentors and designations like Bank on Yourself. So if I don't know who you're working with, but if they are not a Bank on Yourself professional, it's very likely, after watching this and being in the room here today, Steve, you now know more about this process than your advisor does, very, very likely. And so that's okay. There's a broad financial universe out there. Not everyone should have a corner on truth, not even Dave Ramsey. So don't feel like you have to educate your heart surgeon before they put you under the knife. It's okay to look for an advisor that does know what he or she is doing.
All right, good question, Steve. Let me have a clicker. Any
sure.
other questions from the room? Anybody or online? Adam?
Is there any restrictions on how much you put in? I know you gave the example about putting the 14 in there. Does that sit in there for any amount of time? Is that just depending on how you structured when you said the 18 or 40,000 or whatever? Is there any limit to how much you can put in or how
Yeah.
that works?
Great question, Adam. So Adam asks, hey, is there any limit of time before you can access the money? And you brought up another side question I'll add to that, which is, hey, is there any flexibility on what we can put into these policies? So no, typically within about 2 weeks of the check clearing or your draft of your policy's premium, you can be accessing the loan against the policy. And the loans themselves take about a week or so to process the loan, generally speaking. So yeah, usually it's within the first month from when you start your policy to when you're using the policy, if you needed it right away. And again, work with a professional who can help you think about a strategy to repay that loan to your policy that you control, but it's on your schedule. Also, I'll just briefly mention, you can put in differing amounts, like varied amounts can go into your policy. I showed examples of same amount going in every year. A lot of us are business owners, and a lot of times profits go up and down. Well, you can do that with these policies. I didn't show that today, but a lot of your contributions might be varied in their amounts. The amounts can be very flexible, what you put in.
Yeah, well, that my experience. I have 3 different policies. I've got one that and by the way, too, I funded mine. This is just full disclosure on how I did mine. I'm not saying this is the way you should do yours, but when I learned this 4 or 5 years ago, we got out of everything. 403B, 401k, stock market. I cashed everything out. The benefit was that I was not in a taxable situation anyway, because as I said earlier, I don't make any money on paper. So I was able to pull all that money out and only pay the penalty that I had to pay on the 403B and the 401k. And I moved 100% of the cash into life insurance. And so I did one policy, single premium. And I don't remember what it was, but it's 6 figures. Dropped it in, never had to pay on it again. I had access to that money within 30 days.
Yep.
And we bought a property in an Airbnb property in East Tennessee. And, that's an investment for us. So I've got 6-figure annual premiums on some policies, and I've got actually, I think all of ours are 6 figures. The super ninja way, as he calls it, on this Bank on Yourself policy, is that 100% of your income goes into the policy, and then you pull money back out to pay your expenses. I'm not there yet, but I'm working towards it. What I want to do, if I make 300 grand this year, I want to take that 300 grand, put it directly into the policies, and to borrow what I need to live on, because I don't need 300 or 400 or whatever I make. I don't need that to live on. I only need probably 150 grand to live on, 180 grand, whatever it costs me to live. just borrow that out, and then all that money continues to grow. So that's the Super Ninja way to do these. The black belt
Yeah,
version.
black belt. I always say don't get into the dojo with the black belt on unless you're really trained for it. So I would say start with the white belt first.
All right. So I know we have other questions, but we're up against the time clock, so I'm going to quit here. I will say this: I do have an announcement, and we do have some giveaways that we're going to give away. So the giveaways I'm going to do after we go off the live, because I don't want to waste the live time giving away books. But if you want free giveaways, you got to show up live. So make sure you're here at the next event. But everybody's going to go home with a couple of books. And then we got a couple of books that we're going to give away just to certain people I'll talk about in a minute. But I want to first of all say a big thanks to Mark Willis for flying down from Chicago and being here with us today. And I do encourage everybody to book your time and to go talk with him. Even if you have it already, or if you don't know what you want to do, this guy can educate you and tell you about how this might work in your plan. So go talk to Mark, and to go to that bit.ly/mycall, and you can book that for free strategy session. If you're a member of my Exeter Club, you get a much longer strategy session for free that you can talk with him. So if you're interested in knowing what the Exeter Club is, just talk to me afterwards, or go to theexeterclub.com. Let me tell you about our next event. Our next event is coming up on September 6th. It's with a guy named Ross Flutterjohn. He's one of the world's leading experts right now on AI. And AI is ever changing. It's changing every single day. But we're doing this event on September 6th. It's AI for entrepreneurs, supercharged growth with smart copy, with visuals and chatbots. We're actually doing it on lead gen. So we're talking about lead gen. That's really the main thing, is we're going to show you in this 2-hour live session how to build your own lead generating chatbot for your business. So no matter what business you're in, we're going to show you how to do it in that 2-hour section. It's only $47 a ticket, just like this, just like you paid today to come live. The live stream will be free. So if you're watching this live, you can do that. But we have 2 extra opportunities at this event that we've never done before. We're offering a VIP ticket for $297 that includes, after the 2-hour session, we're going to break. Everybody's going to, general admission, people are going to leave. The VIPs are going to stay. We're going to cater lunch. And then we're going to do a 3-hour session where we're going to show you exactly how to build it. You will walk away with a chatbot built for you that day. That's a $2,000 value for $297 that you'll have done that day. And then for 5 people who want to up their game and get coaching on this, Super VIP is only $2,500. That includes dinner at the Standard that night, one of the top steakhouses in the country, one-on-one time with me and Ross, 3 months of coaching with Ross on AI, and his team at Stammer.ai is going to build a fully automated chatbot based on AI for your business. That's like a $5,000 value. It's only $2,500 to do the Super VIP. So go to therealjasonduncan.com/EMS live, like what's on the screen. Please register for that event. But again, big thanks to Mark Willis for being here today. Let's give him a hand. Thank you for being here, man. Appreciate it.
Thank you, guys.
Thank you guys for getting online, for being here with us live. And I will see you next time. And thank you guys for being here live in the room. You guys in the room, stick around because we got some giveaways. But we'll go ahead and sign off. Thanks. We'll see you next time. Let me know when we're clear.